Randy?
Thank you, Kevin. It's great to be with you. I've really enjoyed today. I've learned a lot. I think everybody in the room has learned a lot. If you haven't been listening. And that's what it really is about, is getting together and sharing ideas, talking about things that, hey, there's a lot of things out here that all of us are trying to get our arms around. And what I'm going to try to do is give you a little bit of a sense and feel of a number of the things that we're dealing with here, not just in the cattle business, but in the entire livestock industry. So I've got a few slides up here that I'll walk you through. I'm going to go through some of them fairly quickly, so we've got time for a few questions as we wrap up. First thing I want to just kind of bring you all up to speed on is sometimes just stepping back and looking at some of this data from a macro standpoint, I think is helpful for us. This gives us a good reflection of what has happened across all of these ag commodity markets in here since they made their highs, whether they made them in 2012, 13, 14, whatever the case may be. Bottom line is basically all of these markets have dropped 45 to 60% in here the last few years. This was led by the oil market, wasn't it? Oil market started down. All of these things came down together. We talked about the dollar this morning, with what happened with the currency. Obviously, that had a huge impact on exports, especially starting in 2014. The summer of 2014, things really shut off on us. The one thing I would say to you when we look across these markets is we really believe that a lot of these agriculture commodity indexes have made a bottom. Whether you're looking at the Bloomberg Commodity Index, the CRB Index, any of those things, we think they have made a pretty significant low in here. The question is, can we get enough wind in their sails where we can actually start a higher trending market, or we're just going to have to chop along in here for another 12 to 24 months? If you think back and you think about pork production, you look at the hogs on that previous chart, and hogs have been down about 60%. But we've had some excellent profitability. Fair to finish operations over on the hog side, been very profitable over the last 2 to 3 years. Packing segment. What about what's happening in the packing segment in hogs? We've brought 2 more hog plants online in here this fall. We've got 2 more coming on next year. Big deal. That's a big deal. And again, we've seen the hog market start to come back seasonally in here over the last several weeks and start to get a little bit of wind in its sales, along with the cattle market. Some of these things are pretty seasonal in here, but this one I think will be a bigger deal because of the increased packing capacity. The hog market and the cattle markets have both had one common denominator. There wasn't enough kill capacity. There wasn't enough slaughter capacity to handle the animals we were bringing to market, and that's part of the reason we've seen the leverage shift that we've seen within both those segments. We're not going to fix that in the cattle side anytime soon. I don't see any new packing plants coming in on the cattle side, but that is being fixed as we speak in here on the hog side. The poultry side, same situation. Look at the growth in poultry. Look where we were in 2008, 9, 10, 11, 12. It's pretty flat. Same situation on the pork side. Production was flat. Those livestock industries couldn't be profitable with $7 and $8 corn. That's basically what happened. So it was a trade-off as we went through this space in here. When we look at it here today, I think this is the simplest way for you all to look at what's going on in the livestock industries. The U.S. and Brazil are the 2 800-pound gorillas in the global livestock markets. Look at the production increases we've experienced in here on the protein side the last few years. 2.5 pound increases, 15, 2.5 billion pound increase in 16, again in 17. You can see our forecast will be over 2 billion pound increase again in 2018. So we've got a lot of protein coming on these markets. You wonder why these markets have been trading the discounts, why they've had the volatility in them. The markets have been worried, what are we going to do with all the protein that's coming online? They've not been trading what we see out here 30, 60, 90 days down the road. I think in many cases these markets have been trading what they're looking at 12 to 24 months down the road. So when you look at this, you look at the export side, again, put this in perspective. We were exporting 16 billion pounds of protein back in here earlier in this decade. And that export number dropped to 14 billion pounds. A 2 billion pound drop in exports at the same time we had a 2.5 billion pound increase in production. A 4.5 billion pound change in net supply of protein on the U.S. marketplace. Never in the history of the U.S. protein market have we ever experienced anything like that. The single largest one-year increase in protein supplies. Again, we can't make this stuff up. You couldn't forecast it. I guarantee you couldn't forecast something like that of that magnitude happening. This is really, I'm going to jump over here, this is what it looked like to each and every one of you as a consumer. Find the second to the last blue bar on that chart in front of you. We were basically consuming 200 pounds of protein per person in 2014. Look what we consumed this year. 213 pounds. A 13-pound increase, and basically that happened in an 18-month period of time. Pretty incredible, isn't it? Pretty incredible. So the market went through a shock. The thing that I want you to see on this chart, this is what we were consuming in the previous decade. We're basically just going back to levels that we were consuming in the previous decade. Again, it's not like the markets haven't been used to it, but we have to buy market share of that stomach back, don't we? And that's what we've been going through. This big break in prices that we've experienced, in my opinion, is starting to buy market share back, consumer market share back. And I think you'll see that play out in here. We'll see these markets start to show some stability in here over the course of the next 12 to 18 months. We've got the lion's share of the down in here. That's what I'm trying to say. These markets have broke hard. We've got the lion's share of the down in here. Doesn't mean the trends aren't still lower, particularly for cattle. But we've gone through already a 45% drop, and I think that from that perspective, it's important for you to see that. Now, let's shift gears and just look a little bit globally what we're talking about here. Just simplify this. The U.S. and Brazil export 50% of all the protein that's traded on the global market. That's a simple way to think about this. We don't compete against each other on a very high percentage of the markets that we go to. From time to time, for example, in 2014, when we were in record expansion in the U.S., we went through this situation in here. Let me jump over here. You can see this chart right there. Look at the red line. We sent a signal to the world that we needed more lean beef in the United States. We didn't have enough. 55% of our consumption of beef in the United States is in the form of ground beef. When we're expanding the nation's cow herd, when we're going through that, we aren't harvesting cows, are we? Where's our lean beef supply come from? Okay? So we need to import more of that to be able to mix with our fed trimmings to come up with that supply. And that's what we were doing in there. Now that imported number is declining. It'll be down 12 to 13% this year. It'll be down, I would guess, another 7 or 8, maybe even 10% next year because we don't need as much of that supply going forward. So these markets are pretty efficient with the ebb and flow and sending signals that we need more, we need less. This is just one example of how that works. Obviously, we have more total beef production coming online right along with the pork and poultry. No surprise to you. For those of you that are financing guys in the cow-calf side, this expansion was the fastest expansion I've seen in my career. Why wouldn't it be? Record prices. When you're sitting here making $600, $700, $800 a head for cow-calf operators, and we've got replenish our water supplies, and we replenish our forage supplies, we're going to expand. We got green grass and profitability will expand. So that expansion rate, you can see what is happening in here. This will be the last year of the big aggressive expansion in the beef cattle side. It'll still grow yet in 2018, and won't see the increased beef production in that until 2019. So I had a question from a number of y'all today, how long does this cycle go yet? It'll take to the end of this decade before we get to the peak of production. Inventory numbers will be at their peak numbers here, and basically by 18, production levels at their peak by the time we get to the latter part of the decade. Now, for those of you that are history buffs in the room, I thought you might get a charge out of this. This is going back and taking you through all of the cattle cycles in the last 40 years. Just giving you a feel of how much they correct and how fast they correct. Again, most of these cycles will tend to correct in 30 to 35%. The one we've just come through, we've already been down 45%. But I want to remind you, from the time we made our lows in December of 2009 to the highs we made in November of 2014, our markets went up 117%. Kevin, I couldn't believe we could have a market that moved that fast. Went up 117%, so we basically we started this bull market that we're in the cattle market from $80. So you'd have to look at that as, while I'm not forecasting that the markets are going back to those levels, that's where it started from. So you have to look at it and understand that that is a risk level for us as we move forward here. Now I mentioned to you the slaughter capacity. This has been the single biggest change that we've gone through. Our markets are down $25 a hundred this year. I've heard all this conversation today with supply, demand, global trade, dollars, this and that. Let me just give you a little bit of a feel of how I would do the analysis in our space. We're down $25 a hundred this year. $10 of it is from supply and demand on the beef side. 10 of the $25 a hundred reduction is from supply and demand. The other $15 a hundred is leverage. It's total meat supplies. It's lack of packing capacity. It's all of those things combined. So again, that is a little bit of a change in world for those of you out here trying to forecast markets. And I heard everybody say, well, we just can't tell. We don't know where it may go. Well, that's it precisely. When we heard the grain panel today, we got the same thing here on the cattle side. These markets get cheaper and they get higher than what you think they may get when you look at the underlying fundamental data. And that's why I'm sharing with you the insight that I am relative to the way these markets are moving. Look at this data here, though. Look how fast it can change. We closed packing plants for a decade. We closed them for a decade. Now we don't have enough hooks. We got to harvest. We harvested 1.3 million more cattle this year. We got to harvest another 800,000 head of fed cattle this next year. So this is the challenge for us as we get into that July to September time period, where we could run into the same kind of issues that we've run into the last two summers and early falls. So I think we have a seasonal risk in these markets that each and every one of you, your producers, need to be aware of. I'm not going to talk about these global indexes. I don't want to run over here on my time commitment. I want to spend just a couple of minutes in here talking about price levels and where we may trade. You can see in here what I'm showing you on the previous chart, on this chart, relative to where this market started from, where the bull market started from in 2009, 2010. Basically from that 80 to $1 range that we were trading in, the market rejected this area down here around $1. The question has been, we basically have gone through 2 years with no profitability. 2 years. We made $6.5 billion on the rally going up, and we gave it all back in 12 months. It's a hell of a business, huh? We're finally getting to a spot out here where I think we can capture some margin. You look at these numbers in here, the way we would do the supply-demand analysis, we believe we're going to average in here this $1.07 to $1.10 for the year. We'll have a market that can rally up in here into the low 120s at some point, and a much more seasonal market, and risk back into the mid-90s sometime out here in that late summer, early fall time period. So the trends are still lower, aren't they? The trends are lower, and I would say over the next 2 to 3 years with these increasing production levels, you need to dial that in. But I meant what I said. I believe we have the lion's share of the break in this market. The lion's share of the break is in it. Now we're going to start to get a little more two-sided. The funds, what's going on with the funds and the way these markets are trading? The funds have been pretty short the cattle market for quite some time. The funds are finally covering shorts. We've got the largest net long position on the funds in here today that we've had since the spring of 2015. So they're starting to come out. We also have the commercial, again, i.e. the cattle feeder, that is starting to sell into this thing. And they're selling into it because the purple line is above the green line. The purple line is, will the futures markets give us a margin? Can we hedge a profit margin? Over the last 3 weeks, we've been able to start hedging a margin, and people are starting to walk into it because it's been such a long time since we've been able to do that. So these are the things that I see happening out here. I think the worst of the equity drain in the cattle side is over. How about the dairy side? Dairy, the dairy herd is flat this year. If anything, the dairy herd is going to be up 100,000 head this year. The dairy industry is making a little bit of money right now, so we're not seeing any liquidation as far as dairy cow numbers are concerned. As I mentioned, the pork segment has been profitable for the farrow to finish operations. Poultry has been profitable. Large poultry integrators have been profitable through here. So we are seeing these protein sides. They're not big margins in here, but we are seeing some at least small positive margins start to develop there. The cattle market or the livestock feeding market was the last one to get there, and I think we're finally there with it as well. Now, for those of you that finance a lot of cow-calf operations, I wanted to share this with you. I think these are some pretty good numbers. We survey a lot of cow-calf operations around the country. And we watched this cattle market drop $1,000 a head. That's how much lower we are than where we were in 2014. We dropped more in the last 12 months than what any of us in the cow-calf business had sold one for prior to the last 5 years. My family's been in the ranching business since 1887 in northeast Colorado. And, you know, to sell calves at $2.70 a pound is incredible. Absolutely incredible. And everybody in this room knows what I mean. We're now basically back in here. If you look at calf prices today, they're basically back to 145 to 150. So they bounced back from the 120 area. Average cow-calf profit margins to the average producer in the United States, 140 is a break even. We think we'll average about 150 this next year. So the cow-calf operations, about half of them will make money, about half of them won't. That's why that expansion rate is slowing down the way it is. So, again, there's a big range. Your last panel talked about the range in productivity. There's about a range. We've got cow-calf producers that would make money at $1. We've got other cow-calf producers that lose money selling calves at $1.80. And that's why I'm trying to give you the benchmark that I am in here, that we're basically back in where we'll still be a small positive margin, but again, the big heavy lift and the big profit margins are now behind us. So we just got to get through it and do the same thing the grain panel talked about this morning, is focus on productivity, focus on doing all those little things right, and we'll be able to get through this next 2 to 3 years of the downside of the cycle. With that, let's take a few questions if we got time. Anybody have a question?
Got anything?
Don't be bashful. I'm heading to the airport in about 3 minutes, so The question is how dependent is the cattle industry on DDGs? We obviously feed a lot of DDGs in our feed yards, supplement our rations all the way through the Texas Panhandle, all the way up through Iowa, Nebraska, to the Dakotas, and the whole 9 yards. So it is a significant part of it. I don't think they're going to go away. I think we'll have that feed available for those operations as we move forward. Could we adapt? Absolutely. We could adapt if we didn't have it. We didn't have that, really didn't have much of that in our feeding rations until 2007, 2008 when we really built out. So it's relatively new when you look at the history of the cattle industry going back over time. Yes?
Is there any plans to put any more hooks online on the cattle side anywhere in the future, or is it they just going to depend on running that over capacity to meet the demand?
Well, it really became a labor issue. Just think about what you hear from all your customers out here. Labor is a huge problem, isn't it? It's a huge problem in here, and even this summer and fall with record packing margin. I mean, we had record packing margins in the cattle feeding side, or for the packers harvesting fed cattle. We've never seen margins like this. We had weeks where margins were up close to $200 a head. So you don't see that very often. Part of it is government regulations have slowed these chain speeds down, and then closing all this capacity. I think we forget how much capacity we closed. We closed capacity that would have harvested 105,000 more cattle a week just on a 40-hour week. That's how much we've closed since 2005, 105,000 cattle a week. So I don't see more hooks coming online in the form of more plants, but I think we can get some more efficiency with existing plants and get more throughput from those plants. So it's going to be an issue for the feeding industry at least the next 2 to 3 years as far as a lack of kill capacity. No doubt about it. Now, we fixed it in the hog side pretty fast, didn't we? How do you fix it? Record margins. That's really how you did it.
Randy, question. So the kill capacity, the deferred months discounted to the nearby months right now, obviously that's showing up there. What time does that kill capacity, when do you want to kill these cattle? Like November, October, December? I mean, obviously, them months aren't showing that. They're showing, you look at the futures, they're discounted the same as the July to September. Why?
Okay, I got the question here. This is when you want to harvest the cattle if you can manage that harvest level where we basically will be killing a 40-hour week. December, January, February, March, early April. That's the time period where there's no more than a 40-hour week available. From May, June, July, August, September, October, we've got to harvest 44, 45, 46 hours a week. And if you're going to harvest that many hours a week, you're going to incentivize a packer, i.e. with bigger margins, to harvest the cattle. Did that answer the question pretty clearly?
Beef exports without TPP, any comments on that in the U.S. dollar and maybe which countries you would anticipate?
Say that again?
So beef exports, the outlook in which countries, and then without TPP, maybe the changes on that.
Beef exports, big deal. We export about, let's just stop and think about exports in total. We export in excess of 7 billion pounds of poultry, 5.5 billion pounds of pork, and about 2.5 billion pounds of beef. Beef exports will be up 7 to 8% this year. I think they'll be up 5 to 6% next year. The big markets for us right now, the hot markets, are South Korea, Hong Kong, and Japan. I don't see anything changing with direct access to China. That's going to be slow. We're going to continue to go into Hong Kong with that product through the gray market. That's where that will find its way through there. I think that we're ways away to get direct access to China. So Those are the key markets for us in here, and the ones that I would say we have to continue to grow. Just think about this. This simplify this. 2.5 billion more pounds of production on an annual basis, beef, pork, and poultry. We better be growing exports, aren't we? If we're not growing exports, every one of you in this room is going to be eating a lot more protein. Well, you're not going to eat a lot more protein at the same price if that's the case. A simple perspective for you. If you look at our population in the United States today, and let's just call it 330 million people, we export 41 pounds per person. That's what we're exporting today. That's how important those exports are to us. Just to give you a perspective on a U.S. basis. And those will need to grow to 50 pounds in here as we get into this next decade to where we can keep these markets from overwhelming our domestic consumer. Thanks for having me. Great to be with you.